Joining us now to talk about the IPO market is Bessemer Venture Partners partner, Byron Deeter. Byron, it's been a while. Good to see you.
Thank you.
So, I mean, the post-IPO market for some of these names not looking so hot. We just talked about Instacart. ARM's also down. These were largely small floats. I assume they were boosted up, at least for the first couple days, by supporters. But now, so what does that say about the IPO market?
So I think we should keep some perspective. We obviously went from one of the largest IPO markets in history, 2021, to the worst in the last 25 years, last year in 2022. And I think we've got a tale of really 3 quarters ahead. These companies, in an absolute sense, are still solid valuations in the $9 billion-ish range. If you look at Instacart and Klaviyo, Birkenstock, they expect will trade in a similar range, and ARM, obviously, a multiple of that, but much larger scale. However, we've got a pretty modest IPO pipeline ahead for this coming quarter. We might see a couple on the enterprise side, names that are mentioned a lot, Rubrik or Cohesity, maybe on the consumer side, something like Toro, but almost certainly it's going to be in between these extremes of the last couple of years and a pretty lukewarm environment over the coming months. Really what we're looking forward to is Q2 2024. So 3 quarters out, companies will drop in their financials. Hopefully interest rates will have stabilized a bit. And we see this massive pipeline that's been building, the largest in our lifetimes, finally able to start looking towards those markets. And we think it could be a monster Q2 if things stabilize in the macro.
What about names that have already gone public, like HashiCorp, that, you know, the public market hasn't been kind to?
The multiple compression's been rough. You look back, HashiCorp was the last IPO, December 2021, 2 years ago, and it had been a ghost town until Klaviyo and Instacart and ARM opened things up just in the last few weeks. Again, in an absolute sense, the valuations are solid, but the multiple compression has people worried. You look at the quality of these companies, and that's where I might disagree a little bit with some of the prior commentary. Klaviyo's a fantastic company. Instacart's a solid business, and they're trading at pretty modest multiples. And so everyone else is looking at those comps saying that's a tough class to compete with. We're going to continue to build scale and work our way up. And that's what we expect to see. We think that some of the very strongest names, companies like a Databricks that people are looking at, a Canva's mentioned a lot. Those are the names that people are looking to be the bellwethers of next year. And we think they could pull a lot of really high quality companies through with them.
Okay, so we've just established that the high quality companies are going to be the ones that potentially go public next year. What happens to the ones that are not so high quality, especially in a private market where we've seen capital dry up?
We hope the M&A markets follow, but that's been slow. The Splunk Cisco news was a meaningful flag that we hope may signal some opening. However, the valuation mismatch has been massive. Private companies have still been holding on to some of those valuations from their last rounds. Multiples often deep into the double digits on a revenue multiple basis, while their public peers are trading at 6 to 8 times for quality names. We think that the convergence is starting to happen, and that's where you'll see some of the M&A unlock. But we have hundreds of billion-dollar companies in the private markets that need a path forward. We think that dozens of those will follow through the IPO path over the next 2 years, but the remaining companies are going to have to find exits of some form or fashion. The vast majority of those will go the M&A route in the coming years.
Okay. I mean, we've had this conversation repeatedly on this show. I think about Jennifer Nason from JP Morgan last week talking about the fact that basically the spread between bid and ask is still too large, whether you're talking about IPO market, whether you're talking about M&A, or even talking about, you know, credit markets and debt issuance right now. What is it going to take to see that narrow? Does the ask portion need to come down, or I guess what I'm trying to get to is, especially in a higher interest rate environment, are we going to see another re-rating in the private markets?
There needs to be a convergence. I think you're absolutely right there. And it's going to be a combination of multiple factors where I think the team does meet in the middle. There will be a re-rating. The public multiples are unlikely to rebound to the 2021 levels anytime soon. And so we think that the private markets are more likely to come down to those multiples. There's a growth adjustment that will happen. It's quite rational to still pay double-digit multiples in the private markets, where they may trade at high single-digit multiples in the public markets. But the solve function there is the growth rate. And so we think that as the private companies burn down their balance sheets and they have to go back to the private markets, and as some of this backlog of private capital that sits in funds like ours and others starts to be drawn down, we'll see companies that start to work down their valuation expectations, and deal volume will start to unlock. It has been slow. It's taken longer than most of us expected, but we do start to see signs of deals clearing, and the bid-ask spreads mathematically are converging.